Hello and welcome to the quarterly context webinar for the first quarter of 2018 for clients of the advisory group and WealthStep. WealthStep is the division of the advisory group that provides simplified service for up-and-coming clients and 401k plan participants. Our quarterly context webinars are designed to provide high-level perspective regarding the economy, markets, and investor behavior patterns in order to help both our personal wealth and institutional clients better achieve their goals. We try to keep these to about 20 minutes, and we'll circulate a link afterwards should you like to review a portion of it again or to pass it on to someone you think we can help like we've helped you. If you have any questions, please submit them to the question box, and we'll either address those as we go along or at the end of the presentation. As always, we start with a quick peek at the concept of keeping an eye on what matters most to you and the things that you can control in the context of your goals and what the desired versus required outcomes are in the short term and the long term. If we take a peek at recent market results, we can see some red arrows, meaning some negative numbers for the quarter, although numbers were all positive for the year across markets. But the U.S. stock market, international real estate, and securitized real estate, that is, and the U.S. bond market were all down for the quarter in what was a period of returning to more normal levels of volatility after an unusually extended period of low volatility, hitting in some cases all-time or near all-time lows in terms of stock market volatility. The year, however, was still quite strong despite some of this short-term weakness for the quarter, and the volatility to a great degree after some of the news about the potential benefits to stocks of a tax cut. Fed rate hike expectations, talk about tariffs, the spending bill being possibly larger than expected, tension with North Korea and Russia, and general turmoil and staff turnover in Washington created a bit of a shift from what was previously overly optimistic sentiment. It's also notable that bonds, the 10-year Treasury hit 3% during the quarter, but finished up at 2.74%, and yield, and the 3% mark, which has subsequently been bumped again during the second quarter now, is a bit of a benchmark number for sometimes triggering investors to have a bit more concern as bond yields become more attractive, and therefore stock attractiveness is slightly lower, and that can increase some volatility in the stock markets. In terms of the quarter as well, the S&P 500 saw 6 days of market swings that were 2% or greater, including one 4% downswing near the beginning of February, versus no such 2% swings during the entire year of 2017. So certainly a bit more volatile, but not entirely out of line with what's a bit more normal in the long run. Here we can see recent news events. It's common for any given news event to push the market up or down a little bit, but in the long run, all turns to smooth out. But you can see here again some of the bigger news initially with some of the tariffs and a little bit more protectionist type policy that created some level of concern. In terms of a few economic details, the GDP was revised upward to 2.9% for the fourth quarter. Europe hovering around 2%, and sent signals that they are going to reduce their stimulus program in Europe. Fed rates went up another 0.25%. That's the 6th increase since 2015. And additional rate hikes are expected, about 2 to 3 in 2018 and 3 or 4 in 2019 if the economy progresses as projected on steady, mediocre but reasonable growth. Inflation hovered about the same, up just slightly, giving some inflation-sensitive securities some sense that a little bit more inflation may be on the horizon, giving some of those securities a boost. Unemployment still hovered around 4.1%, falling slightly, still around the lowest level since 2000. And by contrast, full employment in Europe is a bit closer, and traditionally Europe does have higher unemployment rates versus the U.S. On that full employment measure, and currently stands at 8.6%. Wage growth up just a little bit and above inflation rates, which is somewhat of a sign of growth and potential higher inflation to some degree down the road. And the long-term average is 4% wage growth for comparison. The other element that might just be worth mentioning is the dollar weakened a bit, and that had an impact on local versus foreign currencies in terms of any given investments held. Taking some of those elements and taking a step back to longer term patterns, you can see how unemployment has been ratcheting down gradually since the end of the global financial crisis. Wage growth has been improving, but on a more slow pattern. Consumer sentiment, despite some of the volatility in the quarter, continued to rise a little bit. Wouldn't be surprised if that cools off a little bit as the wealth effect concerns possibly increase. Oil, again, picked up speed a little bit here, and that has interesting implications both politically and economically. And again, inflation remaining very tame, hovering, but increasing slightly. And lastly, corporate earnings, despite the volatility that we've seen, corporate earnings remain strong, even despite more recent news about Facebook and data sharing or data stealing by other organization concerns, depending on how you look at it. And the projected earnings are also relatively strong. So there may be some increased volatility in those tech data spaces, but fundamentally still some good signs in terms of overall economic stability. Taking a look at the long-term four bad bears chart, we can see where the current global financial crisis and subsequent recovery market stands. This chart is after inflation, which is why the current market stands so far above these other markets in part. And we look at a before inflation chart, you can see that's actually somewhat of a similar pattern to the 70s oil and financial crisis. And but again, on an inflation adjusted basis, has been a faster and stronger recovery in great part due to extended stimulative policy. In other words, that may have led to some artificial boosting of the markets, and might be expected and normal to have some the correction we've seen to get back to a little bit more average returns after a period of unusually high returns. Taking an even broader look at markets, going back to the early 1900s, we can see that there are patterns where the market bumps up and down, has a significant rise, fall, recovery, and then there tend to be some somewhat extended periods where the market bumps around but essentially goes sideways. So that's important to keep in mind. Essentially from the top of the dot-com boom through part of the global financial crisis recovery essentially represents a flat market. Now we've been in an upswing. The question is, what happens next. Are we heading into a bit of a flattening period? That wouldn't be surprising. Just the question is how flat, how bumpy, and how long. Valuations in terms of stocks have come down a little bit with that volatility. That makes valuations look relatively more attractive than they were recently, and also somewhat or slightly relatively more attractive than the long-term 25-year averages, as you can see for the US, Europe, and so forth, even emerging markets, which until recently were looking more relatively attractive and have had a pretty strong run-up, including a 37% return in 2017. Here we can see where the dollar has cooled off a little bit, and on this lower right chart we can see the volatility index represented by the VIX. It's called the VIX index. Period, the global financial crisis spiked, 2010 spiked up, 2011 spiked up a little bit into not abnormal levels, and now after a period of extended low volatility, really from the middle of or beginning of 2012, now we've had a bit of a spike here and bouncing around in more normal levels. So it's important to get comfortable with a certain level of volatility if you're in a portfolio that is appropriate for your needs and goals. Then looking at the quality thermometer, we take a peek at what types of stocks in terms of high versus low quality, and by quality that often means relatively strong balance sheets, low debt, potentially higher cash positions, and so forth. In other words, higher stability, less volatile stocks versus more speculative, more volatile stocks. Overall, high quality outperformed in terms of quantity of market segments, but the lower quality, higher speculative stocks, which includes some technology and big technology names, which have especially large weights in the marketplace, had, although there was fewer areas where low quality outperformed, the proportion of the numbers was more impactful. So if you see a negative number here, that means that low quality actually outperformed high quality by that amount, or in other words, low quality underperformed, high quality rather underperformed low quality by that amount. And over time, you can see how in the last 10 years, in a relatively speculative period and cheap money monetary policy period, higher quality stocks have, while have done fairly well on an absolute basis, not quite as strong versus the more speculative stocks that have gotten a boost from that cheap money period post-global financial crisis. Another periodic table type we have for you, whereas in the past we've shown you asset classes and different types of periodic tables. This table shows returns by year by sector. So same pattern in general relative to the other periodic tables, which is that there's very little pattern at all. Returns tend to be very random, unpredictable, and this is one of the best cases for building and maintaining a diversified portfolio in the absence of a crystal ball and knowing what's going to happen next. Taking a peek in terms of our behavioral finance section, this update to mutual fund industry cash flows shows that investors continue to move money around, with some money moving out of U.S. stocks given some of the volatility, also out of cash, and for the most part moving into bonds. However, still money moving materially into overall world stocks, and that some of those shifts naturally happen after the market volatility, and when recoveries happen, then people tend to miss out. So that rear view mirror driving generally detrimental in the long run. Also, in terms of behavioral finance, if we look at how some people might view volatility as a major risk and concern, even though it's only one of several risks and is the only risk that has a reward in the long run in the investment space versus inflation and other types of risk. A reminder here that if one were to miss miss just the best 30 days over a course of 50 years, that would lead to a 40% lower return. So you really have to be in it to win it. No one can predict when the market will cool, and being disciplined and sticking with it in the long run leads to better outcomes. Of course, it's important that you find and maintain a portfolio that meets your needs given either the different life stage or organizational stage, to know that you are being disciplined with a portfolio that's a good fit. In terms of behavioral finance and saving, recent studies indicate that there's a large number of people, 64%, believe that they will need more than $500,000 for retirement, whereas the average person by age group here has materially less than $500,000, $120,000 for those in the 55 to 64 category, and so forth. So a material disconnect between the perceived need and actual need and the actual savings behavior. Taking a peek at that over time, you can see how the average 401k plan balance is one proxy for the average savings across the country, what those account balances have been. Of course, this doesn't adjust for inflation, but it gives you a sense of how low some of those numbers are. And different studies will show slightly different numbers, but generally roughly in the range you see here. And this one particular study suggested that the average person would need about $740,000 to fund their retirement. Longevity research is also proving helpful for planning and as a point of interest. This recent study shows that what's not news is that women tend to live longer than men for a number of reasons. However, what this study showed was that life expectancy also increases with household income. So that can be attributed to potentially an array of things, including the type of work, whether it's more physically demanding, also the access to food quality, nutrition patterns, medicine, and medical support. So unfortunately, not something that every person can control, but there are some advantages in terms of longevity and the correlation to wealth. Taking a look at very long-term forecasts, it's always interesting to see how longevity has shifted over time. Back in the mid-1800s, longevity was, life expectancy was around in the 45 to 50 range, whereas gradually that's increased over time as diet, nutrition, and medical advances have extended life, with life expectancy being up in the closer to the mid to upper 80s more currently. In terms of the overall retirement landscape, no big surprise here that the primary retirement spending of the average person is on food, healthcare, transportation, and housing. And the average age of retirement in the U.S., maybe somewhat surprisingly, is 63, younger than the traditional age 65. And as people live longer, consistent with the longevity data that was just shown, it may be not only likely but necessary for the average person to extend their working years longer due to the difficulty in funding a retirement that is otherwise becoming longer and longer. As information for those of you that are 401k plan fiduciaries or of self-directed plans, a recent Callan study indicates that plan sponsors are most heavily focused on really what's most important in terms of moving the needle for plan participants. And interestingly, a shift towards being more focused on outcomes. So wellness and income adequacy, and then contribution levels and participation really fold into those numbers. And all of the top 6 areas fall squarely into the focus as well, interestingly, of the advisor group's Wealth Step program and online advice system that is under testing now and expected to be launched this summer in terms of the aim, save, invest focus. So these 4 represent the aim and save segment. Investment, somewhat appropriately, is next in line, not the primary focus, because saving is really the most important driver of retirement success, readiness success. And then, of course, spend is really the 4th leg of that stool for aim, save, invest, and spend. And spending wisely helps ensure avoiding longevity risk and running out of money too soon. And here are the top methods of communication for addressing these different communication areas. Then, in terms of the rules and regulations corner, some interesting updates that the Consumer Financial Protection Bureau, a court ruled that that entity is constitutional after all, and so that makes for an interesting potential shift in Washington, or at least some level of possible limits related to the current administration's attempt to dismantle that organization. However, we'll see where that goes. Also, the fiduciary rule, which was previously extended more recently in the middle of March, was struck down entirely. And the DOL does not plan to enforce it as a result. And some experts we're hearing from say that appeals are unlikely. So that has implications for a number of different factors. And again, the fiduciary rule, for those of you that attended previous discussions regarding this, relates to retirement plans and IRA accounts, which are the elements that the Department of Labor oversees, but had general implications for how large financial institutions in particular would have to position themselves, and what types of elements they could agree to, would be required to disclose and agree to in terms of acting or not acting in the best interest of their clients. As you surely know, the advisory group has always accepted fiduciary status in writing. We were one of the first organizations in the industry to do that decades ago, because it's part of our philosophy to always do right by our clients. Also, Congress moved closer to undoing some of the global financial crisis banking restrictions, and the Fed also floated an idea of relaxing some rules around stress tests. So the reason we mention these 2 items here, as well as the CFPB item, is that all of those, any relaxing of that nature tends to cause financial organizations to take more risk, and that can increase volatility in the markets. No real updates otherwise for fiduciaries. Tax laws have had a minor impact on retirement plans, despite initial concerns and idea floating in Washington that more significant changes might occur. And then lastly, Wealth Step status. We are currently doing beta testing with clients and an extended group of people outside of clients. Feedback has been solid at this stage, and we currently plan to launch, depending on depending on the feedback, by the end of the beta, to see what types of adjustments we might make to make this tool as helpful as possible to people. And we hope for personal wealth clients that this type of tool will also be helpful to their adult children, both as a financial literacy and basic planning tool. So stay tuned for more on that. So thank you for attending today. We value your thoughts. We appreciate those of you that are clients and friends of the advisory group in terms of our work with you. And we always want to make sure you're well supported, and would appreciate any feedback If something ever occurs to you that you think we could do better, please shoot us a note. We want to be the best organization we can to support you as a client, or those of you that have clients in common, to help achieve successful outcomes.